Hi everyone, this is Mrs. V Chan. Welcome to my Form 5 Accounting lesson number 21. Today is 20th of May 2020. Alright, so today's topic is ratio analysis, and then we will do this DSE question in 2018. Alright, so here we have the question in 2018, and then what we need to do in part A here is to calculate these ratios. Okay, but something very, very important. So we are given this additional information, point number 1. Point number 2, we must analyze this additional information first. Otherwise, all calculation will be wrong. Okay, so the first thing, let's look at number 1 here, saying that all sales were made on credits. That means there is no cash sales, and this is the total sales, 780,000. Okay, so therefore, this is also the total credit sales. But here, some goods were sent on a sale return basis and then were recorded as credit sales. Now, this recorded as credit sales is correct or wrong, depends whether the customer accept the goods or not accept the goods. But if you keep going and look at this line 3 here, all these goods were returned by the customer, so therefore we cannot count this as credit sales. Alright, so this is wrong. Therefore, we need this adjustments here. So number 1, we have total credit sales, and this goods sent on a sale or return basis. In this situation, return basis should not be a kind of credit sales yet. Okay, so therefore, what is the double entry to correct the mistake? Therefore, we have to reverse the double entry for sales. Okay, so the double entry will be cancel sales, debit sales, and credit trade receivable by the amounts, which is 17,000 and 17,000. Okay, so therefore, after the analysis here, we have sales being overstated. However, if you go through these items, so we have sales actually included in this retained profit. So why it has been included as retained profit? So here is the analysis. Now we have sales overstated, sales too large. Then what happened to gross profits will be too large. Then net profits will be too large. And then finally, retained profits also be affected, which is also too large. So that's why we have sales affecting retained profits in this way. Okay, and also for trade receivable, because it should not be counted as credit sales, so trade receivable should be also overstated. Now, this analysis is very, very important because we need to adjust this when we do calculation. Okay, so therefore we need to minus retained profit by this 17,000, and also we need to minus 70,000 from trade receivable as well. Okay, next, and look at this goods returned. Actually belongs to the company, so therefore goods returned should be included as closing inventory. And if you go back to point number 1 here, the question says here, and were included in the closing inventory. That means we do not have any mistake for closing inventory. There is no adjustment related to closing inventory. Okay, so since we do not have any error for this closing inventory, we don't need any adjustments related to that. And also here is the diagram for point number 2. We are given total purchases and saying that 80% were credit purchases and 20% for cash purchases. Okay, now after these adjustments, we can go do calculation in part A here. So part A number 1. What we need to do is to calculate working capital ratio. Okay, and actually this working capital ratio is same as current ratio, right? And the formula is equal to, we have current assets minus current liabilities. Okay, so in this 2017. Okay, now let's look at the question. 3% long-term loan is a kind of non-current liability, and now we have this 3 5% short-term loan is my current liability. So I have this 90 for current liability short-term loan, and accrued expenses here is also a kind of current liability, 15,000. And next I have cash at bank, which is current assets, 128,000. Okay, next equipment, non-current assets, inventory, closing inventory. So current assets, so 364,000, like that. Okay, and then retained profits, not relevant. Trade payable, current liability, so I put here. Okay, and for trade receivable, which is current assets. However, in point number 1, okay, what is adjustment? We have trade receivable, which is overstated like this. This is the analysis we had before, right? Trade receivable overstated, so that means I need to minus this goods sent on sale return basis. All right, so that's all the steps for calculating working capital ratio. Okay, then you can use your calculator to work out the answer, and then we give answer in 2 decimal places, and that is 2.1721. And actually, what is the meaning of this? The firm has 2.17 current assets to pay $1 of current liability. So this is the meaning of current ratio. Okay, number 2, we need to calculate inventory turnover, and then what is the formula for that? The formula for inventory turnover is equal to cost of goods sold over average inventory. However, in this question, we are not given cost of goods sold, and then we can use this formula for cost of goods sold, which is equal to opening inventory plus purchases minus closing inventory. And then here, what is the relationship for this closing inventory here in 2016, and this is closing inventory in 2017. So this one, so the closing in 2016 actually will be the opening in 2017. So here is the analysis. Okay, so this is closing in 2017, and this is opening, same as closing in 2016 will be opening in 2017. So that now you can put this opening inventory plus purchases given in point number 2, and then minus closing inventory, and then divided by average inventory, which is the opening and closing, and then you take average. Okay, so then you use your calculator, and then you get 2.20 number of times. So this inventory turnover is to measure how fast that the firm can sell its inventory. So what about if the number of times is higher? That means the firm can sell inventory faster. If the firm can sell inventory faster, that means the firm can change inventory into cash easier. Then the firm will have less money tied up as inventory. So this is the meaning of inventory turnover. Okay, next we need to calculate this average trade receivables collection period, and then here is the formula. So which is average trade receivables divided by total credit sales. So since we have to express the answer in how many days, and then we have 365 days in a year, so that here times 365. All right, so what is average trade receivable? It will be the opening one in 2016, which is closing in 2016, will be opening in 2017. And then for this one, this is the closing. Okay, however, don't forget, in point number 1 here, we have adjustments related to credit sales and adjustments related to trade receivable. All right, so therefore, my calculation will be this, the average. So I take average, so 1/2, and then the opening one is 110,000 plus closing. However, we have trade receivable is overstated because of point number 1, and then divided by credit sales given to us in point number 1, which is 780,000, since there's no cash sales here. And then also the sales is overstated. Okay, so times 365 days. Okay, so then you use your calculator, you will get this 67.69 days. So usually the shorter of the collection period will be better, because if we can collect money earlier from customers, and then the risk of bad debt written off will be lower, and then we will have less finance costs. That means we don't need to borrow money and then to pay interest. Okay, next we have this average trade payable repayment period. That means how long is the credit period allowed by our supplier before we pay back money to a supplier on the due date. And here is the formula. Okay, so which is equal to average trade payables divided by total credit purchases only. All right, and we have 365 days in a year, so that the formula on top, average trade payables, so the closing in 2016 will be opening in 2017, and this is closing in 2017, and then this is total purchases, and here we only consider credit purchases. Okay, so therefore we have this 76.23 days for the payment period, and then usually the longer the payment period will be better to the business, because you have no hurry to pay back the money to supplier, and also this trade credit is a kind of short-term financing to the business as well. Okay, now we come to part B. Number 1 here, we need to calculate gearing ratio. So let's look at the formula of gearing ratio and the meaning of gearing ratio. So here is the formula of gearing ratio. So on top here we have non-current liability plus preference share capital divided by non-current liability plus shareholders fund. Okay, so let's look at this. What is shareholders fund? Shareholders fund is same as equity, right? And equity is also the capital for a limited company. And then let's break down all shareholders fund or equity into what? So we have ordinary share capital. Okay, what else? And then also we have preference share capital. Okay, and then we have retained profits, and then plus general reserve. Okay, so very often we have these 4 things for equity or for shareholders fund. Okay, now I give you 2 situations, and let's say the gearing ratio of company A is 30%, and then there is another company B, the gearing ratio is, okay, let me give you an example which is a higher one. Let's say company B has 60% as the gearing ratio, so that we say this 30%, all right, is low gear for company A. That means relatively company A has less non-current liability and also less preference share capital. Okay, if company A has less non-current liability, so what do you need to pay whenever you have current liability? You need to pay interest. That means less interest. And remember, interest is always fixed. Even though you make a loss, you have to pay interest. And also, whenever we have preference share capital, we need to pay dividend. And then since company A has less 30% only on top of the fraction, so that the fixed dividend paying to preference shareholder will be less. Okay, so what do you think? Therefore, company A has less financial burden to pay this fixed interest and fixed dividend, right? So this is a good thing because it is less risky if you invest your money in company A. So this is the meaning of gearing ratio. Okay, so here we have the opposite. Let's say company A now has 60% as the gearing ratio, and then we say that company A's gearing is high, all right, or high gear. All right, what's wrong with that? That means more non-current liability and more preference share capital. So company B use more non-current liability and preference share capital to do financing. Okay, so what's wrong if you have more non-current liability. Whenever you have non-current liability, you need to pay interest, right? And interest is always fixed. And similarly, whenever you have preference share capital, whenever you issue this, you need to pay this fixed dividend. Therefore, you can see if the gearing ratio is high, therefore the company will have higher financial burden, and then we say that it is more risky to invest in a company with high gear. Okay, so after the analysis, now we look at the calculation for gearing ratio in 2016. All right, so that on top we have non-current liability. So this one, 2016, 3% long-term loan is the non-current liability. So I have this 753,800 on top, and then over non-current liability again, repeat this, and plus shareholders fund or equity. All right, so what I said now here, ordinary share capital. Okay, so what else? Retained profits, so plus 42,000. All right, so I can say there's two things: ordinary share capital and retained profits being the shareholders fund in 2016. Okay, so therefore the gearing ratio in 2016 we have 75.70%. Okay, now we come to 2017. So this is the non-current liability in 2017, and then you repeat this non-current liability, and this is ordinary share capital, right? And then this is the whole thing is retained profits. As don't forget, we have adjustments related to point number 1 here, saying that sales is overstated. So therefore, you can see this is very, very important. So we must go through analysis first before we do calculation. Otherwise, it will be all wrong. So we have this double entry debit sales, which is in retained profit and credit trade receivable. Therefore, the retained profit, you have to minus this 70,000 and also minus 70,000 from trade receivable. Okay, so finally we come to part B2 here. We need to comment on the solvency of the company. And what is the meaning of solvency? It means whether you have the ability to pay your debts, means your liability. That means both your short-term liability and long-term liability. But what do you use to pay liability? Depends how much assets do you have, whether you have more assets than your liabilities. Okay, all right, so here is the analysis. Look at the gearing ratio. Last year, 75.7, which is high gear. High gear means the risk is too high. So, and this is no good. All right, but what about this year? Drop to 17.63. Low gear is much better. So you can describe in this way and saying that the solvency has improved. All right, so why improved? Let's look at analysis here. On top, last year, we have this non-current liability, 753,000 something, and going down to 180,000 as the non-current liability. Okay, so here, that means the company repay a large portion of long-term loan. This is good because if you have less long-term loan, you pay less interests. You have less financial burden. And also, if you compare the figure for ordinary share capital, last year 200,000, and this year going up to 700,000. So what happened? The firm has issued more ordinary share capital. Okay, this is fine because for ordinary share capital, the company does not need to pay any dividend because dividend is not fixed, depends on whether you make profits or loss. So relatively, you have much less financial burden in 2017. Okay, so that's all about the calculation and analysis in the DSE question in 2018. Okay, so thank you very much for watching my video. I'll see you next time. Bye bye.